Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 59 of Real Talk. As I record this introduction, I'm a day away from going on my family's summer vacation. We'll be in South Carolina for 10 days, half the time at the Montage Palmetto Bluff, celebrating a good friend of mine's 50th birthday. Yes, it's crazy to think that my friends and I are getting that old. And the other half of the time, we will be in Charleston. Everyone says great things about Charleston, so looking forward to it. So may not have as many shows on during the summer, but I can't wait to tell everyone my thoughts on South Carolina. This week, I have Eli Moghavem and Michael Bastan from Base Equities on. They are a small to middle market preferred equity provider, mezz provider. We have a really interesting conversation about their perspective on the market, where they're seeing distress, why they are choosing to do smaller balance loan amounts and pref equity amounts, and really the key metrics that they looked at as a capital provider on the credit side. It's a really interesting conversation that I had with them, and I hope you enjoy it. Welcome to another edition of Real Talk. I'm here with my good friends, Eli Moghavem, Michael Bastan of Base Equities. Fellas, what's going on?
Happy to be here. Thanks for having us, Andrew.
Thanks for having us, Andrew.
You guys sound so excited. I just love the energy is just oozing off of the computer screen.
I've been waiting for this day my whole life.
There you go. So, all right. Well, at least you're lying. So, look, guys, let's just jump right into it. I hope a lot of my listeners know who Base Equities is, but in case they've been sleeping under a rock the last few years, what is Base Equities?
I'll give a little background intro. Mike can piggyback off that. But we started Base Equities about 3 years ago, capitalized on the dislocation in capital markets. So we came out with rolled out a platform that was specially focused on smaller balance, preferred equity, mezzanine, and LP allocation. So $1 to $5 million investment in a preferred equity or a mezzanine position. We raised a fund initially, did a bunch of deals. Now the market's kind of moved in our favor. Capital markets still aren't what they were. There's a big gap created in the debt markets, a big gap created in the equity markets, which gives us a bigger kind of playground to play in. So coming in, just doing those smaller balance equity allocations, which are very, very supply constrained.
Yeah, just to piggyback on that, we realized, we probably realized well before, rates went up and COVID and all of that, there's historically always been a big supply-demand imbalance on, let's call it the small to middle market. So all your pref funds, your debt funds, they all generally want to go bigger and bigger, which is the $10 million check sizes. At the same time, people raising in this field typically aren't institutions, or they don't have institutional partners. They're more going to be syndicators. So you have low supply from capital providers here. And also on the demand side, you have a lot of demand for this. So it really enables us to kind of capitalize on this imbalance and, bring a product to the market that we really thought was needed. And based on kind of the response we've had and the number of deals we're seeing, I can say it's definitely needed.
Yeah, I was going to ask you, are you guys drinking out of a fire hose? How
I would
many?
say one of the hardest things is deal intake,
Yeah,
making sure we have the bandwidth, because as you can imagine, I mean, we get inundated with deal flow, and as soon as the market realizes, all right, this is a group that has, money, and dry powder, they'll send you, everything with the kitchen sink. So you'll see, first mortgage requests, you'll see LP requests, you'll see co-GP requests. So we really get to see everything. We get to have a finger on the pulse. Luckily, we've hired well, which helps us look through everything very quickly. And thankfully, we've developed a pretty good sniff test where we can pass on transactions that don't fit the box fairly quickly, not really waste anybody's time.
yeah. So I mean, just curious, how many deals do you see? I don't know if you monitor on a daily basis, weekly basis, monthly basis, just an approximate of how many deals you see, how many deals do you sort of dig in, and how many deals do you close?
So we get about 100. We do monitor everything. I think data is king. We get about 120 to 150 transactions a quarter. In 2023, we received over $2 billion of requests, and these are requests that are coming in between 1 and 5 million. So it is a lot of deal flow. I'm not going to act like even, majority of them are not actionable. Most of the stuff you're seeing, value is maybe below the debt balance. These people are throwing one last Hail Mary to save their deals. So we do get to be like the first line of defense and seeing, where the distress actually is in the market, which I think is a very cool place to sit in today. But we are, I mean, the deal flow is crazy. And how many are we closing? We're targeting about 25 to $30 million from now to the end of the year in fresh origination. So hopefully end, 50 to $75 million a year is our target.
Yeah. So I do want to touch upon what you said as to where you're seeing the distress. But before we go there, I have a lot of conversations with clients as it relates to deal size, the cost, the amount of time, and it almost becomes like this organic realization that some people get to a point where they realize it takes the same amount of time to do a small deal as it does to do a large deal. And from transactional costs, legal fees, things of that nature, the deal size almost is irrelevant. Although we have to keep it relevant because you just need to for things to make sense. But do you guys ever feel like, gosh, we're doing a lot of work for small deals, and would it be better to go at a higher loan amount, but then you're going to be bumping up against these institutions?
So yeah, that's a great question. It's definitely more work. The question is the work is the juice worth the squeeze? So are you being compensated for it? And there's a couple of things here. Firstly, operationally, you need to kind of have a back end in order that runs things as efficiently as possible, deal intake, closing deals, servicing, all that, because you're obviously dealing with smaller checks. But there is a yield premium associated with this that kind of more than offsets the additional work involved. And ultimately, I mean, I'm going to speak for myself. I'd feel a little bit more comfortable instead of having one $20 million check, having that that $20 million spread among, say, 6 deals or 7 deals. So I've got a lot more diversity, both in location and also possibly asset type. So it spreads the risk out a lot more without giving up anything on the yield. So in a nutshell, I mean, Eli probably has something else to add, but for all those reasons, it for us, at least it's worth it.
Yeah. Now, what about competition? We see from a law firm perspective, a lot of private lenders out there, whether it's senior, stretch senior, mezz, pref. Do you feel like the market is oversaturated with folks that are providing this type of capital, or do you think there's so much demand that there's plenty of room for your competitors, and that you're not having to scratch and claw to get a deal done, and I don't know, reduce certain terms in order to get a deal? I mean, how do you see sort of the supply demand balance?
Yeah, I think if you start to go out for $7 million and above of preferred equity, you will get 30 term sheets. They all look and smell the same.
Yeah.
You can put them against each other. You can shop them, and you'll get pricing between 12 to 14%, and the sponsor can really dictate terms. The space that we play in, if we're losing a term sheet, I'd say generally we're losing it to existing LPs in the deal. And from my perspective, there's no better validation that I'm pricing and structuring correctly than an existing LP in a deal saying, you know what, I like that term sheet, I'll put out the same exact terms.
Sure.
But from the place that, the space that we're playing in, we can throw our weight around. I mean, we can command pricing, we can command terms. I can credit enhance this thing, left and right. I can add in reserves. I can put in removal rights. I can take equity pledges, because at the end of the day, there's generally no other alternative. I think there's maybe 2 or 3 people that are playing in our space, but we all structure very differently. It's not competitive, it's more collaborative. So I'm constantly making referrals to the other pref providers in my space, because I know, hey, they might be a little bit, more flexible on structure, but their pricing might be higher, or maybe the complete opposite. So it is collaborative. We do trade deals. But I like being in this small balance range because for that exact reason, there is not that much competition, and I can throw my weight around.
Yeah. Now, I know every deal stands on its own, and pricing and terms are so specific based on property and leverage and location and quality of sponsor. Are you able to tell my audience, if they come to base equities, just generally what they can expect in terms of leverage and length of term and yield and points, knowing that every deal is unique? And
so my I think over the last 2 years, if there's one lesson I learned, it's cap rates don't mean anything anymore. So being able to put a blanket, all right, we go up to 85% loan to value, it's really meaningless. You have the deals that are, underwater that somebody bought with floating rate bridge debt 3 years ago, and the loan's coming due, and that's got a leverage point that's so out of whack and a capital stack that's so broken that irrespective of what your leverage point is, you might be underwater day one. And then you have the other deals which somebody might be buying, really, really well, and they got some discount on an off-market deal where leverage might smell a little bit higher, but at least we're more intact in a value perspective. So what we usually use as a metric to size our loans is debt yields. I think cash flow is the one thing you can depend on in this market. So sizing to, a 7.5%, 8% stabilized yield on cost on our last dollar, I think on a market rate deal is somewhere between 80, 85%. That's where we'll size to. And then in terms of pricing structure, look, we're able to achieve high yields. Our fund is generating north of an 18% today. I think we're trying to keep yield in that area. Our idea has always been if we can give half of their investor returns on a current basis, we're doing pretty good. So if we're generating an 18% and we can give our investors a 9 or 10% current on a quarterly basis while they wait for the rest of that accrual payment, I think they've been very happy. We've been very happy. I think it's a good blend of current pay and some upside.
will you guys do construction?
Not yet. I mean, I think let's get some more bodies. Let's grow a little bit. Let's scale. I think one thing that we learned in this past market, without having to name names, is we're very cognizant about scaling too quickly. and not having the asset management infrastructure build out to be able to handle those if things were to go wrong. So right now we're only investing in deals that we would be able to manage if we had to. And Mike's got a long track record of operating all types of assets all over the country, which we rely on him for a lot of that asset management expertise.
But not construction. So that's why now we're staying away from construction. We want to, we definitely want to be conservative on that side. And I mean, it's not that we want to take over an asset. It's not something we've ever done, but we just have to be cognizant that it's an asset type that we're comfortable with.
Is the most common request for your capital the following fact pattern, where generally a multifamily owner operator, their senior loan is coming due, it is most likely a cash-in refinancing, and the sponsor doesn't want to put up more money of its own or go to its LPs, and therefore you bridge that gap to get the gap that the new lender has essentially created?
Look, I think that's a very significant amount of deal flow. I would say 9 out of 10 of those opportunities from our perspective are not actionable. And this is something
they are not actionable.
Not actionable. And this is something that we've spoken to you at length about, and Katie on your team, and for us, it's always come down to, and look, I'm a recovering lender. I don't think I'll ever be able to fully recover. So from my perspective, it always comes down to how can I credit enhance this to a point where I feel okay coming into a deal that's 3 years baked with, LPs and GPs that might be fighting, with an asset that who knows what's been done on it for the last 3 years. And the question that we've spoken at length about is how do I structure around that? Can I get an indemnity? And if I do get an indemnity, is the indemnity really worth anything? If this guy's asking me for $1 million or $2 million, probably not. I mean, I'm indemnifying myself against an entity that is nearly insolvent, or an individual who doesn't have the deep enough pockets to save the deal himself. So there are, of course, deals that we look at on a rescue capital basis where they make sense, and it's with a sponsor, and I think that's what it comes down to, with a sponsor that's very transparent, and they'll tell you all the facts on that first call. But I'd say most of them are not, and they're still, for lack of a better word, out in the market looking for the stupid money that it still existed in 2018, 2019, where you could convince somebody over around the Gulf for a couple of drinks to invest a couple million into your deals. I think the market's got a little bit smarter recently.
I'll tell you what's interesting though, Andrew. Probably our main source of deal flow is still new acquisitions, not cash in refis. And what we're seeing this year, say compared to last year, is now we're seeing deals come at a much better basis with more higher debt yield or yield on costs, better cash flow. So that's actually, even though you would think we see a lot of cash in refis, and I think it's partly because of the size of the space we're in, there's still quite a lot of acquisitions going on.
Yeah. And so, Eli, you alluded to, and the question's for both of you, but I know Eli alluded to it earlier, that you are in a unique position where you see where the distress is in the market. I've talked about this on my podcast ad nauseum. Probably the audience is tired of it, but the distress, the real distress that we've seen come to transactions is in office, and in multifamily. We're starting to see, I guess, a pickup of deal flow activity, distress that's coming to market, short sales, and things of that nature. Curious what your observations are as to where you see the distress, but not just borrowers who are in distress, but distress that is actually culminating with a transaction.
Look, because of the seat we're in, where this is usually somebody's last shot to be able to save their deal, we're on the front lines of seeing that. And I've been saying this for probably a year and a half, is that I think the entrance into equities is via credit. And I think there's no better space to get equity-like yields, get equity-like returns, get equity-like exposure than being in a preferred equity or mezzanine position, because you're still getting a double-digit and a high double-digit return on your money, but you're at a way more justifiable basis than where the common equity is, and you have the controls to be able to right the ship if things aren't going according to the business plan or where they should be headed. But with that said, we're able to kind of see these trends before they actually happen, whether that be frothiness or volatility in a certain type of debt market. And you will see, all right, things going from debt fund execution or local bank execution to then it went the agencies. And now what we're seeing is most competitive is CMBS on multifamily, which you would have thought CMBS would come in more competitive than both Fannie and Freddie. So we're able to get a kind of a first look at trends, more macro trends like that. Which markets are we seeing all of a sudden a lot more deal requests from, whether that be Houston or South Florida, which you can kind of read between the lines, and it's, surprise, surprise, insurance renewals that are killing those deals. And so just the position that we're in lets us get exposure to those things, and then lets us make more informed decisions about those things. And I would say a debt fund or a strictly equity group that, their data or their knowledge is trailing a couple months behind.
Are there any asset classes besides multifamily that you have done and want to do more deals of?
So, I want to say about 18 months ago, we had a deal sent from a broker, and the subject was basically outdoor storage. I know this is crazy, but hear me out. Never ever heard of, IOS, as it's called, industrial outdoor storage, until this point. We're like, well, this is just land and you park stuff on it. What's this all about? But it turns out it's a really good asset class. So we've done at least 4 iOS deals so far. 6? Wow. I've lost count, but it's just turned out to be some really random asset class we didn't know about. And just by being in the space, we found out about it. So it was, I personally love it now. I think it's great, but it was sometimes kind of the business leads you to places you wouldn't expect it to go, basically. And this was definitely one of them.
Yeah.
I'd say another thing we learned was, look, at the end of the day, again, this is putting the lender hat back on, is you got to be paid for the risk you're taking in a deal. And one of the things we saw in the last 6 to 9 months were yields on multifamily product for kind of rescue capital pref was going down. And so this would price at 16, 17% a year ago. Now people are putting out money on the same deals at 14, 15%. From our perspective, the risk profile on that deal has not changed. The only thing that did change is the entrance of more liquidity into that market. And so from our perspective, we're stuck saying, all right, our favorite asset class, the one we understand most, the one we have most exposure or experience with, is multifamily, but the returns are not justifying the risk at this point. So where can we seek yield? Where can we seek an outsized risk-adjusted return, which we're seeing it in iOS. We're seeing it in shallow bay industrial. We're seeing it in retail. And we're doing a deal right now, which is, funny enough, a rescue capital deal on a brand new, fully occupied retail property right outside Houston. And this deal is going behind CMBS. There is a significant amount of sponsor equity. Sponsor is one of those that was very transparent on the first call. They're stroking a check at the same time we are, which just shows that they want to continue putting their skin in the game. And so that's a deal that we're getting a 17% yield on, and a significant amount of that being current. And our last dollar leverage, I want to say, is in the mid to low 70s. So that feels like a pretty good deal.
One of the key factors when borrowers are evaluating which private lender to select, assuming they have multiple lenders to select from, is certainty of close. Can you talk about how you guys are capitalized and just how the fundraising environment is for you? I mean, everyone's raising money, whether you're, unless if even banks are raising money, right? So how are you capitalized, and how's the fundraising environment?
Yes, so we raised a fund about 2 years ago. And then we partnered with a firm out of Baltimore that invested a sizable amount that would co-invest with that fund. We're starting to scale up now, just again, by virtue of there being so many opportunities and so many good opportunities out there. We never want to be done in capital raising. And credit goes to you, Andrew, for making a fantastic introduction to a group out of Connecticut. They've actually got a couple names, but they have the Corridor Ventures or Apparent Capital, which we're working on kind of getting more of a programmatic JV structured with them. They're traditionally more of a syndication shop from high net worth family offices, private equity firms. So we're looking at kind of, base equities 2.0 with them would be kind of broadening out our investor base, joining forces on our investor bases and seeing if we can scale up from there. So again, thank you for the intro. We're working on our first 3 deals all going on at the same time now. So
as you're looking at the market going forward, it's interesting. I guess the analogy I'm going to make is, people who transacted in the office space, transition to industrial, or other asset classes have transitioned to follow the market. Equity groups, like you alluded to before, said, why not play in the preferred equity mezz space where I could get the same returns? And so now it's so hard for sponsors to get common LP equity because everyone wants to get pref. I guess the question is really, how does this cycle end? How do we get out of this? Because client sponsors, your sponsors and borrowers, need to raise common equity. If all the common equity and LP providers are now playing in your space, how can we ever get deals done?
Well, I'm going to tell you, relative to kind of our deal space, our deal size, even though our yields are pretty high, because of that supply-demand imbalance, we generally are accretive to our sponsors, which means, they have some home run deals where the LPs are getting mid-20s higher returns on their money. So, and also, as Eli said, we get beaten up by LPs sometimes who rather match our terms or do similar terms instead of taking prep. So I've actually found it quite interesting, but in generally, if the deal is good and it makes sense and the basis is good, as long as the sponsor is somewhat decent at fundraising, it's not been as problematic as I thought it would be, in particular in this space. I mean, I do accept it's challenging, but I think if the deal's good, the money will always be there.
Did you have visions when you were setting up base equities that the market was going to turn, and the experience that we've had over the last 2 years is really the reason why base equities was set up, and it's not because of how the market was in 21? You were just setting yourself up for a market like what we're in today.
Well, actually, only 50%. I mean, I can tell you a little bit about my background. I was a multifamily GP syndicator. I was doing deals all over the country, and my business model was focused on buying deals at a really good basis, usually CD properties, fixing them up, selling them still at a good basis. And what I realized is every single year, insurance shot up, taxes shot up, COVID hit, labor shot up, and it was becoming a lot more difficult to kind of run a strategy like this with properties all over the country. And all the pressure was focusing towards more kind of specialists doing it. So I realized that it was becoming more challenging on the GP side, on the multifamily side. And in 2021 and 22, I was selling, and a lot of groups were going on a buying spree at the time. So I'm sat here thinking, in full honesty, wow, am I the idiot? These guys are buying all these properties, doing all this stuff, and I'm not. I just don't feel comfortable buying it, and I'm going to switch to the pref as well, because I realized at the time you could get the same returns doing the pref. What I did not see was that on top of all those expense increases, I told you, you're going to see a massive rise in interest rates, which was kind of, it's a double-edged sword, because it's harder to find deals that make sense, because obviously the lender gets paid before us. But at the same time, it did open the floodgates to pref a lot more than we anticipated. Like, we primarily thought our plan was going to be just dealing with people buying and great acquisitions. And then I guess the cash and refi was just more deal flow on top.
Yeah. I know, Eli, we lost you for a second, and I asked Michael, when you guys started the company in 21, it was a completely different market than it is today. And the market has moved really to your favor with the product that you are providing. I guess let's end with the last question, because I'm want to be respectful of your time. You've been around for about 3 years. What's for those that are looking to be entrepreneurial and set up their own shop, whether it's on the GP side, LP side, pref equity side, what's the biggest challenge or two that you didn't expect that you would be facing as an entrepreneur and starting your own business?
Mike, you want to go first, or you want me to take this one?
And maybe it's each other. If so, we have plenty of time to sort this out.
Yeah, look, from my perspective, it's structure. I've always worked in a very structured type of position. Before this, I was at a debt fund for about 7-8 years, and that was way more institutional. And I think one of the things I learned, and it was hardest to do, was kind of getting that institutional, departing from that institutional brain. Not everything has to be done a certain way. When you're an entrepreneur, you can kind of write your own script. You can be a little bit more creative. And I think I was very fixated, especially in the first kind of year or two, by being overly, and it's not a terrible thing, but overly compliant, overly diligenced. I kind of beat everything to death until Michael's equity hat was able to corrupt me into having a little bit more appetite for risk, having a little bit more appetite for doing things a little bit differently than how I was always trained. So I think that's just growing pains of being an entrepreneur and starting something new. But look, we've done pretty well so far.
So I think the biggest challenge is really getting started, because especially as I was saying about the challenges of being a GP, everything has become a lot more specialized. You need a lot more expertise, a lot more focus. So it's really having that track record that you can then communicate and get your investors going and build a team and get the whole thing on the show. So I think the real challenge is find your niche that is the area you are the specialist in, or you want to be specialized in. However you do it, even if you just have to, get the equity, even if it's suboptimal, just to build your track record and show you can do those deals and get the whole show on the road, basically. And then as you do that and you get known as the person and you in that field and you've got that track record, it's going to get easier for you. But it's just the challenges those first few years getting it all started.
No, it's so true. The way you just described it, Mike, you can that applies to all businesses, applies to my situation, my law firm, and I speak to many clients who are looking to make that switch and become an entrepreneur, starting their own business. And yeah, it's good to evaluate, but sometimes what do they say? It's paralysis by analysis, or is it analysis by whatever it is. You just got to start, and then success breeds success, and then at some point you'll reach this inflection point where, look, we're all selling, but at some point you don't have to sell as hard because you have that track record. People are coming to you. And so I know with Base Equities, with your track record, even though it's only been 3 years, the number of deals that you guys have been able to close, certainty of closing, being fair, and obviously we do a ton of work together. And so I'm not surprised at how successful you guys have been in a short period of time. So I just want to say congratulations to all your success so far. And I know it's just the first step of many. And I really appreciate you guys taking the time and coming on to the show.
I appreciate it. It's a lot of fun. Thank you, Andrew.
Thanks, Andrew.
All right, guys. Be well. Thank you.
See you, buddy.
Bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.